In this week's Screen of the Week, we will look at the Joel Greenblatt Magic Formula Model, which is a model that combines both value and quality metrics. In this video, we'll walk through the actual model itself, the inputs and the criteria in the model, and then we'll look at the screen on Validea and identify the stocks that score highly according to the model and add in our own fundamental criteria. In this overview, we'll look at a strategy that combines Warren Buffett's quality measures with Ben Graham's deep value approach. This was developed by Joel Greenblatt and outlined in his book, The Little Book That Beats the Market. The key fundamental investing insight here is this: stocks that exhibit a combination of discounted valuations and high returns on capital can produce outperforming returns for investors that have the patience to wait for the market to recognize their potential. At a high level, the strategy uses two relatively simple criteria. It ranks all stocks on how inexpensive they are, using enterprise value to EBITDA, and then it looks at the quality of the underlying businesses using return on capital. Stocks then receive a combined ranking, and the highest scoring stocks are the one that are favored by the strategy. The source and the evidence behind the model, we base this on Greenblatt's book, The Little Book That Beats the Market. In his backtest from 1988 to 2004, the top 30 stocks selected by this strategy and rebalanced each year showed a backtested return of 30.8% per year over that period versus 12.4% for the S&P 500. The investment thesis is this: public companies are businesses just like private ones, and valuing them based on similar criteria such as the price you are paying and the return on capital that they generate can help identify the most attractive investments for investors. Now let's take a look at the model. This is based on the strategy by Joel Greenblatt outlined in his book, The Little Book That Beats the Market. The first step is to determine if the company is trading at an attractive valuation. To do this, we need to calculate the earnings yield. Earnings yield is calculated by dividing a company's earnings before interest and taxes by its enterprise value, which not only includes the price of the company, but also the amount of debt it uses to generate earnings. Stocks are then percentile ranked by earnings yield. This specific valuation criteria is the portion of the strategy that represents Ben Graham's value style of investing. Next, we need to determine the quality of the business. So to find high quality companies, we look at return on tangible capital. This shows how well a firm is utilizing the capital it employs. Stocks are percentile ranked based on return on capital. The higher the return, the better. This is the Buffett high quality portion of the model. The last step is to calculate the combined rank using the value and the quality metrics above. So what this strategy does is it ranks stocks based on the combination of these two scores, and the top 5% of stocks in our database are the ones that pass the model and should be considered. For investors looking to combine Ben Graham's value approach with Warren Buffett's quality approach in a systematic way, the Magic Formula earnings yield model is a good way to do that. Okay, so what we're going to do here is we're going to go to the Guru Stock Screener on Validea. That's just research in Guru Stock Screener. And in this dropdown where we filter by individual Guru strategies, we are going to choose the earnings yield model, which is based on the Joel Greenblatt strategy. I selected strong interest, which this is going to show me all stocks that score at least 90% according to the model. So this model percentile ranks based on the two variables, earnings yield and return on capital, to find stocks that are exhibiting both value and quality. But the list is pretty long, so let's sort of start to narrow this down. I'm going to add a trailing PE, a maximum of 10. So this will keep us in what I would consider more the deep value set of stocks that's selected by the model. So it's stocks with a PE of 10 or less. And then I'm adding a long-term earnings growth hurdle of at least 15%. So I want to see companies that have grown earnings at least 15% a year annually over the past 5 years. The list is still pretty long, but let's look for stocks that have that are below their 52-week high. So we want to see stocks that are at least 20% below their 52-week high. So that means that they're still, obviously they have low PEs, but they're well off their 52-week highs. And then the last criteria I'm going to add in is a quality metric, the current ratio, which is current assets over current liabilities. We want to see a ratio of at least 2. And as you can see, when we filter on the Joel Greenblatt strategy and then add all these different criteria in, we get a handful of stocks that pass with these additional filters. Thank you guys so much for watching. We'll see you next time.